Hello, I'm John A.G., and if you've been watching the markets closely this week, you may have felt that subtle sense of unease that usually arrives before something important breaks. Not panic, not euphoria, but that quiet moment where price action stops making sense on the surface, and you realize the real story is happening somewhere else. Gold has reclaimed the $5,000 level. Silver has pushed back to 80. Those numbers alone are enough to grab attention, but they are not the story. The real story is what is quietly unfolding behind the scenes at the Federal Reserve and why most investors are completely missing it. This is not about a single rate decision or a press conference headline. This is about a structural shift that historically changes everything for precious metals, and especially for silver. When markets move this fast, people instinctively look for a trigger, a headline, a crisis, a data print. But the most important forces rarely announce themselves that way. They show up first in balance sheets, in liquidity plumbing, in places that feel boring until suddenly they are not. Right now, the Federal Reserve's balance sheet is sending one of those signals. After years of deliberate contraction, something has changed, not in rhetoric, but in the data itself. And when you understand what that change has meant in every previous cycle, it becomes very difficult to ignore what it implies for the months ahead. To appreciate why this matters, you have to step back and look at the path that brought us here. At the height of the pandemic response, the Federal Reserve expanded its balance sheet to an unprecedented level, reaching roughly $8.8 to $9 trillion in total assets. This was not a gradual process, it was a flood. Trillions of dollars were created in a very short period of time to stabilize markets, support credit, and prevent systemic collapse. That liquidity did exactly what liquidity always does. It flowed into asset prices, stocks surged, real estate exploded higher, and precious metals responded forcefully. Silver, in particular, provided one of the clearest signals. In March of 2020, silver briefly traded near $12 an ounce during the liquidity shock. Within 5 months, as the balance sheet expansion accelerated, silver climbed to nearly $30. Gold moved from around $1,500 to above $2,000. These moves were not driven by jewelry demand or industrial consumption. They were driven by liquidity. They were driven by the recognition that currency was being created far faster than real goods, and that paper promises were being diluted in real time. After that phase passed, the narrative shifted. Inflation surged. The Federal Reserve pivoted from easing to tightening. Quantitative easing gave way to quantitative tightening. Instead of reinvesting maturing bonds, the Fed allowed assets to roll off its balance sheet. Over time, total assets declined from their peak down to roughly $6.6 trillion. For years, that contraction acted as a headwind for liquidity-sensitive assets. It did not move in a straight line, but the direction was clear. Less liquidity, more stress, tighter financial conditions. Here is where the current moment becomes so important. That contraction has stopped, not in theory, not in forecasts, in the actual reported numbers. The balance sheet has stabilized, and in recent weeks it has begun to tick higher. This is not a dramatic explosion yet. It is subtle, but subtle is exactly how these shifts begin. Historically, the transition from contraction to stabilization is the inflection point. It marks the end of one phase and the quiet beginning of another. And every major precious metals rally of the last 2 decades has started right here, not after the headlines, but before them. This does not mean markets move straight up from this point. They never do. What it means is that the underlying tide is changing. Liquidity conditions that were tightening are no longer tightening. And in a system as leveraged and debt-dependent as the one we are operating in today, that matters more than almost anything else. The global financial system has been built on the assumption of perpetual liquidity support. Remove that support for long enough, and stress fractures appear. Restore it, even cautiously, and asset prices begin to reprice. While this balance sheet shift has been developing, precious metals have been sending their own signals. Gold reclaiming 5,000 is not just a psychological milestone. It reflects a rapid reassessment of monetary risk. Silver at 80 is even more revealing because silver tends to lag gold until liquidity conditions force a repricing. Silver is both a monetary metal and an industrial input, which makes it uniquely sensitive to systemic stress. When silver begins to move decisively, it usually means something deeper is happening beneath the surface. What makes this moment especially striking is how disconnected paper markets have been from physical reality. Over the past several weeks, we witnessed aggressive selling in futures markets, margin-driven liquidations, and algorithmic cascades that pushed prices sharply lower in a very short period of time. On paper, it looked like weakness. In the physical market, the story could not have been more different. Dealers across multiple regions reported shortages. Offers were pulled. Premiums exploded higher. In parts of Asia, particularly China, premiums reached extraordinary levels, at times approaching double the Western spot price. This divergence matters. Paper prices can be pushed around temporarily by leverage, by forced selling, by positioning. Physical demand cannot be faked for long. When buyers line up for delivery, when inventories drain, When backwardation appears, the signal is unmistakable. Backwardation, where spot prices trade above futures prices, indicates urgent demand for immediate metal. It tells you that participants are willing to pay more now rather than wait, because they are not confident supply will be available later. That is not a normal condition. It is a stress signal. As I'm recording this, silver remains in backwardation. The Shanghai premium remains elevated. Physical flows continue moving eastward from Western vaults to Asian markets. This is not new, but it is accelerating. Gold and silver inventories at Western exchanges have declined materially over the past year, while accumulation continues elsewhere. This geographic shift in metal ownership is one of the most underappreciated developments in the market today. At the same time, another rotation is quietly unfolding. Capital that once flowed heavily into digital assets as a hedge against monetary debasement has become more selective. Cryptocurrencies remain volatile, and while they still attract speculative interest, many investors are rediscovering the appeal of assets with no counterparty risk. Gold and silver do not rely on networks, electricity, or trust in intermediaries. They are tangible, they settle instantly, and they have served as money for thousands of years. In an environment where confidence in financial engineering is fraying, that history matters. None of this guarantees a straight path higher. In moments of acute stress, even gold and silver can be sold to raise cash. We have seen that before. Liquidity crises force investors to sell what they can, not what they want. But those sell-offs tend to be brief, and they tend to precede powerful reversals once central banks respond. The key is understanding where we are in that sequence. The balance sheet data suggests we are closer to response than to restraint. The Federal Reserve is trapped by math. Trillions of dollars in government debt are maturing over the next year, and refinancing them at higher rates dramatically increases interest expense. That expense is already surpassing major budget categories. This is not a political issue. It is arithmetic. At some point, policy choices narrow, inflation becomes the least visible option, and when currency is debased to manage debt, precious metals respond. This is the backdrop against which gold at 5,000 and silver at 80 should be understood, not as speculative excess, but as early repricing. The surface narrative will focus on charts and headlines. The deeper story is liquidity, confidence, and the slow realization that the old assumptions no longer hold. And that realization is only just beginning. When you step back and connect these signals, what becomes clear is that the price action we are seeing is not being driven by emotion alone. It is being driven by stress in systems that were designed to operate smoothly only under very specific assumptions. One of those assumptions is that liquidity will always be available when needed. Another is that paper claims can always be settled without friction. Both assumptions are being tested at the same time, and silver sits directly at the intersection of that test. A lot of people still think of silver as a secondary metal, something that follows gold with a lag. That view misses what makes silver unique. Silver is consumed. It is used in electronics, solar panels, medical applications, and industrial processes that cannot easily substitute away from it. Unlike gold, most silver mined is not stored indefinitely. It is transformed, dispersed, and often lost to recycling inefficiencies. That means above-ground inventories are far smaller than most people realize. When investment demand rises at the same time industrial demand remains strong, the market tightens very quickly. This is why the physical signals matter so much. Backwardation is not a theoretical concept. It is a market screaming that metal is needed now. Elevated premiums are not noise. They are the price of immediacy. When buyers are willing to pay significantly more for physical delivery than for paper exposure, they are expressing a lack of confidence in the paper market's ability to deliver later. That lack of confidence tends to spread once it takes hold. At the same time, the Western pricing mechanism remains dominated by leveraged futures trading. Large volumes of silver are traded daily that represent many times the amount of physical metal actually available for delivery. Under normal conditions, that leverage is manageable because most participants never intend to take delivery. They roll contracts, settle in cash, and move on. But when a sufficient number of participants decide they want metal rather than cash, the system becomes unstable. Prices must rise to ration demand and restore balance. We have seen early versions of this dynamic before. In prior episodes, stress built quietly while paper prices remained contained. Then, seemingly without warning, price discovery shifted. Moves that normally would have taken years happened in months. Silver's move in 2020 was one example. What makes the current setup potentially more powerful is that it is layered on top of far higher debt levels, more fragile financial institutions, and a global economy that is less resilient than it was 5 years ago. Another factor that cannot be ignored is the global nature of the shift. This is not a United States-only story. Central banks around the world are responding to similar pressures. The European Central Bank faces stagnation and debt sustainability concerns. The Bank of England is navigating inflation alongside slowing growth. The Bank of Japan remains trapped by decades of yield control and balance sheet expansion. When one major central bank eases, others are often forced to follow to prevent currency instability. Global liquidity, when measured across the largest central banks, is showing signs of bottoming. Historically, that has been a tailwind for hard assets. While this is unfolding, confidence in traditional safe assets is being questioned. Government bonds, once considered risk-free, now carry meaningful inflation and duration risk. Investors who believed bonds would protect them during equity drawdowns have been forced to reconsider that assumption. When both stocks and bonds struggle at the same time, portfolio construction changes. Assets that sit outside the traditional financial system begin to look more attractive. Gold and silver benefit from that reassessment. Volatility itself plays a role here. Sharp moves shake out weak hands. They force leveraged players to exit. They concentrate ownership among those who are less sensitive to short-term price swings. That process can be painful, but it also lays the groundwork for more sustainable advances. Each episode of forced selling transfers metal from speculative holders to long-term holders. Over time, that reduces available supply at lower prices. It is also important to understand why silver tends to move later and faster than gold. Gold is primarily held as a monetary asset. It responds early to changes in confidence. Silver responds when those changes begin to impact real economic behavior. When inflation expectations rise, when energy transitions accelerate, when infrastructure spending increases, silver demand expands from multiple directions at once. That convergence is what creates explosive moves. At current levels, the gold-to-silver ratio has compressed significantly, but remains above long-term historical norms. Over extended periods, that ratio has averaged closer to 15-1. Even during more modern eras, readings well below 60 have been common during strong silver markets. A full reversion is not required to produce dramatic price appreciation. Even a partial adjustment implies levels far above where silver trades today. Against this backdrop, it is natural to ask why prices are not even higher already. The answer lies in the structure of the market. Paper mechanisms can delay repricing, but they cannot prevent it indefinitely. They absorb pressure until they reach a breaking point. The longer the divergence between physical reality and paper pricing persists, the more violent the eventual resolution tends to be. Another layer of complexity comes from investor psychology. Many participants have been conditioned by years of false breakouts and suppressed prices to doubt every rally. That skepticism keeps capital sidelined longer than fundamentals alone would suggest. Ironically, that skepticism is what often fuels the later stages of a move, because it means positioning remains light even as prices rise. When disbelief finally gives way to acceptance, momentum accelerates. There is also a generational aspect to consider. Younger investors who entered markets during an era of zero rates and perpetual stimulus are now encountering a very different environment. They are learning, often painfully, that leverage cuts both ways and that policy support is not unconditional. As those lessons sink in, asset preferences shift. Tangible stores of value regain relevance. None of this eliminates risk. Markets can overshoot in both directions. Sharp pullbacks are part of the process, but risk must be weighed against context. In a world of expanding debt, constrained resources, and central banks forced to choose between inflation and instability, the asymmetry for silver remains compelling. Downside exists, but it is increasingly limited by physical demand. Upside, by contrast, remains open-ended because it is driven by forces larger than any single market. What matters most is understanding that this is not about timing a perfect entry or exit. It is about recognizing a structural change and positioning accordingly. Liquidity cycles unfold over years, not weeks. Balance sheet shifts take time to filter through the economy. Physical shortages do not resolve overnight. These are slow-moving currents that eventually produce rapid surface moves. As this phase develops, noise will increase. Narratives will conflict. Some will argue that prices have moved too far too fast. Others will insist that manipulation will cap gains indefinitely. Both views underestimate the power of sustained imbalance. When supply cannot meet demand at prevailing prices, prices adjust. That is not ideology. It is how markets clear. The next phase will test conviction. It will reward patience more than precision. Those who focus only on short-term charts may miss the broader move entirely. Those who understand why this environment is different will be less shaken by volatility. They will see pullbacks as part of the process rather than as invalidation. What we are witnessing is the early stage of a repricing that reflects deeper truths about money, trust, and scarcity. Silver's role in that repricing is central, not peripheral. It is both a barometer and a beneficiary of systemic stress. And as the balance sheet data continues to evolve, the message it sends is becoming harder to ignore. This is not a story that resolves quickly. It is a story that unfolds as pressures build and responses follow. The foundation is being laid now, quietly, in places most people are not watching. and when the broader market finally notices, the adjustment is unlikely to be subtle. As this cycle continues to unfold, it becomes increasingly important to separate signal from noise. Markets are exceptionally good at distracting participants with short-term drama, while the long-term forces quietly do their work. Headlines will fixate on daily price swings, on whether silver pulls back $5 or rallies 10. Those movements feel important in the moment, but they are secondary to the structural pressures that are reshaping the monetary landscape beneath them. One of those pressures is the simple reality of debt. The scale of sovereign debt outstanding today has no historical parallel outside of wartime periods. What makes the current situation different is that this debt was accumulated during an era of artificially suppressed interest rates. As that era ends, the cost of servicing this debt rises sharply. This creates a feedback loop. Higher interest expense worsens fiscal deficits, which increases borrowing needs, which puts further pressure on rates. At some point, intervention becomes inevitable. That intervention does not have to be announced as a crisis response. It often appears first as subtle adjustments, technical measures, or temporary facilities. Balance sheets expand quietly. Liquidity is injected through back channels. Official language remains cautious, but the direction is set. We are already seeing the early outlines of this process. The balance sheet stabilization is not occurring in isolation. It is occurring alongside growing strain in multiple corners of the financial system. Banking remains a key vulnerability. While the most visible stress episodes have passed, underlying issues have not been resolved. Commercial real estate exposure, particularly in smaller and regional institutions, continues to pose a risk. Loan losses take time to surface. They appear gradually, then suddenly. When confidence wavers, capital moves quickly. Gold and silver tend to benefit during those moments, not because they generate income, but because they do not depend on anyone else's solvency. Another pressure point lies in currency competition. The global monetary system is slowly transitioning away from a single dominant anchor. This does not mean the dollar disappears, but it does mean alternatives gain traction. Trade settlements diversify. Reserves shift incrementally. Central banks increase allocations to assets that sit outside the control of any one nation. Gold has been the primary beneficiary of this trend so far, but silver participates indirectly through investment demand and price linkage. The scale of central bank gold accumulation over the past 2 years has been extraordinary. Purchases have reached levels not seen in decades. These are not speculative trades. They are strategic reallocations. When institutions tasked with preserving national wealth prioritize physical metal, it sends a message about confidence in fiat arrangements. That message filters through markets over time, influencing private capital decisions. Silver's position in this environment is often misunderstood. It lacks the official reserve status of gold, but it shares many of its monetary characteristics. At the same time, it is embedded in the infrastructure of modern economies. Energy transition initiatives, digitalization, and electrification all increase silver usage. This dual role amplifies sensitivity to both monetary and industrial cycles. When those cycles align, silver moves disproportionately. Volatility, however, remains part of the journey. Sharp corrections will occur, they always do. These corrections are often misinterpreted as failures of the broader thesis. In reality, they are mechanisms through which markets rebalance participation. Leverage is reduced, weak positions are cleared, strong hands accumulate. Each cycle of stress and recovery strengthens the underlying structure. Paper market dynamics will continue to play a role. Futures markets provide liquidity, but they also introduce distortions when positioning becomes extreme. Large players can influence short-term pricing, but they cannot create physical supply. When physical availability tightens enough, price must rise to restore equilibrium. That process can be delayed, but not avoided. Inventory trends remain critical to watch. Western exchange stocks have declined meaningfully. Eligible and registered categories both reflect tighter conditions. Meanwhile, Eastern markets continue to absorb metal. This eastward flow represents a shift in ownership that is difficult to reverse. Once metal leaves Western vaults, it does not easily return. That gradual drain reduces the buffer available to meet future demand spikes. Another element shaping this cycle is investor time horizon. Short-term traders dominate price discovery during quiet periods. Long-term holders dominate during stress. As uncertainty increases, time horizons lengthen. Investors focus less on quarterly returns and more on preservation. That shift favors assets with long histories and simple value propositions. Silver fits that description despite its volatility. It is also worth considering the informational aspect of markets. For years, precious metals were dismissed as relics, unproductive assets in a world of innovation and growth. That narrative thrived during stable periods. As instability rises, narratives change. Assets once considered boring become relevant again. The reassessment happens gradually, then accelerates. This is why patience matters. Structural cycles do not reward impatience. They reward alignment. Understanding where we are in the broader sequence allows for calmer decision making. It reduces the temptation to react to every price fluctuation. It encourages a focus on fundamentals rather than emotions. From a historical perspective, the current environment shares characteristics with previous transition periods: high debt, policy constraints, shifting power dynamics. During such periods, hard assets tend to regain prominence, not because they are perfect, but because they offer simplicity in a complex world. They do not rely on models, forecasts, or promises. They exist. Silver's past peaks provide useful context, not as targets, but as reference points. The nominal high around $50 in 1980 occurred under very different conditions, yet the underlying drivers were familiar: inflation, geopolitical tension, and loss of confidence. Adjusted for inflation, that price would be far higher today. The fact that silver trades at 80 now reflects not excess, but the accumulation of pressures over decades. Looking forward, the key question is not whether volatility will continue. It will. The question is whether the structural drivers remain intact. As long as debt continues to grow faster than productive capacity, as long as central banks are forced to manage crises rather than prevent them, and as long as physical supply remains constrained, the case for silver remains strong. This does not require blind optimism. It requires realism. It requires acknowledging that the system is under strain and that traditional assumptions may no longer apply. It requires recognizing that risk cannot be eliminated, only managed. In that context, diversification into assets that behave differently from financial claims makes sense. As this phase matures, more participants will notice the same signals that are visible now. Balance sheets, inventory flows, premiums, backwardation, each serves as a piece of a larger puzzle. Together, they paint a picture of a market adjusting to new realities. The final stages of such adjustments are rarely orderly. They tend to surprise those who rely too heavily on recent experience. They reward those who study history and understand incentives. They remind us that money is not just numbers on a screen, but a social agreement grounded in trust. Silver sits at the intersection of that trust. It reflects confidence or lack thereof in systems that promise stability. As those systems are tested, silver responds. Not all at once, but persistently. We are not at the end of this story. We are closer to the beginning than many realize. The balance sheet shift, the physical tightness, the debt dynamics, and the geopolitical backdrop are all moving in the same direction. Together, they form a powerful undercurrent. Understanding that undercurrent does not guarantee success, but it provides perspective. It allows you to see beyond daily noise and focus on what truly drives value over time. In markets shaped by uncertainty, that perspective is invaluable. Silver at 80 is not a conclusion. It is a signal. What follows will depend on choices made by policymakers, investors, and institutions alike. But the conditions that brought us here are unlikely to reverse easily. And that makes this moment one worth paying close attention to.